I just want to pause really quickly and define or kind of talk about that term reflexivity. And I'll just start first. But the reason I wanted to pause is I've been geeking out on that recently over the last couple months. And the book that I found that I ended up reading is George Soros, The Alchemy of Finance, which is all about it. Is that how you found it? I guess any thoughts to share about reflexivity as a principle?
That is definitely something that I've stolen fully from George Soros, but used in a different context. His was talking about how markets behave and people follow other people and look at one outcome as something that is likely to predict future outcomes in an autocorrelated way and that they move in the same direction. I'm using it in the sense of venture, as I just described, where a company that has a lot of momentum is able to reinforce its momentum by the fact that it has the momentum in and of itself.
And it seems like a core, I mean, just as you were saying that, I just suddenly had this aha moment that it seems like reflexivity is really built into the idea of growth investing, where it is, rather than everything being completely rational. And maybe just to stop there for a second, rewind a second. What I found so interesting about reflexivity is it is just a really simple but powerful philosophical concept to try to answer when you look at something in the world and you try to dig into the underlying facts, but they don't completely support what this thing is trading at or how it's being viewed in the world. A lot of times reflexivity is at play. And it's just this idea that if we were to take an investing example, yes, the fundamentals of a business drive the outcome. But as we see all over the place in the market today, whether it's a SPAC or it's a recent IPO or it's Airbnb being worth, $100+ billion, there's reflexivity in play. Am I getting that right? And is reflexivity kind of a mental tool in your toolkit as you think about growth investing?
It absolutely is. I think it's something that is easy to overweight, but I think it's really important to be aware of. And I've seen it happen many times where a company has a valuation that's nearly impossible to justify at the early stage. But then it goes on and justifies it in your face. And I think if you passed, but it comes back again to probability distribution of outcomes. Let's assume you have a portfolio and you have 10 companies in it. And those 10 companies all are at the very early stage of having a marketplace flywheel, where they're creating value by making a market for customers and suppliers of various kinds. And you see that the value proposition on both sides is really strong. It's just happening. It's like a tadpole. It's not really there yet, but it's just starting. How much is that worth? Well, it's really hard to say, because do you know it's going to actually succeed? No. There's a lot of execution risk. The market could go away and could become irrelevant by the time it can really get to scale. But if you make that bet 10 times out of 10, the times that it works out are going to pay you back tenfold on that fund. And so you have to make that bet because of that. And so it's the reflexivity that drives it from that point. And you have to see it happening right at the start. Otherwise, it's really hard to catch it from there.
What's, I think, powerful about reflexivity and why I think it relates a lot to this notion or philosophy of growth investing is when reflexivity is at play, meaning you're looking at a company and its valuation's insane. It's detached from the underlying fundamentals in the business. If you're taking a growth lens to it, you're not going to necessarily say no to investing, because you know that you can, I guess, back into a little bit of why is it valued at that? What does that mean for future valuations? It's almost like you've driven a wedge in between fundamentals and value, and that can be supported over time. And then as a value investor, you're going to look at that and you're going to think, oh, it's really expensive. And you're not going to invest, and you're never going to have another point to enter because that gap's likely to always exist. One thing I want to just ask as a follow-up question to the kind of first fund you guys had is, did you find that you had to, when entrepreneurs would come to you and you would be talking about providing them with kind of debt venture capital, were there people that were scratching their heads thinking, well, I've never thought about taking debt before? Like, how much did you have to help teach people about the role that debt can play in their business in lieu of equity?
It varied by the company. And one thing that we really learned was to make sure that we were partnering with founders who really got that. Because if they didn't, it meant that the value of the relationship and what we could ultimately create together was more limited. And so it was something that we're in the process of doing, actually. We have a blog post series that's about to come out that really talks about all of these things to help tell that story on a broader scale. I think the idea of trying to save dilution is something that people generally understand. I think it's the reflexivity aspect of it that I think could be told in a way that resonates more with founders. Because I think they get it. When they get a term sheet from a top tier VC, they get what that means. It's the same money, but it's the signaling to the market and the rest of the things that it drives. And so, well, what if they can, when it's time to go raise a series A or B or C, they can be 2 or 3x further ahead in terms of where they are? Well, what kind of reflexivity does that create? And so that's one of the things that I think is I'm most excited to tell, and also to figure out at scale how we can apply it to a number of different industries, which we've already begun to do. I'd be happy to talk about that.